why all these people are here. So thank you very much for all coming. We have a very brilliant panel and a little bit myself, but mainly they're going to make you expert in 30 or 40 minutes on ESG measurement. You won't get a certificate, but you will learn more here than you would do at an MBA elective. So just briefly, let me go around and introduce everyone. My name is Robert Rubenstein. I started TBLI Group. Our work is to change the financial system so it works for everyone, or as my wife likes to say, we make dreams come true, but we're not in cosmetics.
Thank you. My name is Patrick Woodall-Liebe. I'm CEO of a company called Util. And what we do is we use machine learning and AI to map and measure the contributions of every listed public equity in the world, so every listed company in the world, how they contribute to the UN Sustainable Development Goals, both in positive and negative ways. And we provide that data to investors to make better decisions and more sustainable financial decisions.
Thank you so much. My name is Nathalie Leutgeb. I'm a sustainability consultant at Climate Partner, and Climate Partner is specialized in emission calculations, and we help companies understand and calculate the emissions of their own products, of their own business operations, and also of their financed emissions, and help them reduce them and offset the residual emissions that they cannot reduce yet.
From mainly listed companies or all companies?
All companies.
Okay.
I'm Clemens, CEO of Veritat. We as a Veritat, we are here on the market to support companies, being it financial or non-financials, to tackle and handle the taxonomy requirements more efficient, more effectively by providing a digital cloud-based solution. But above of that, we also have an expert pool connected to that digital solution, so that companies who face immediate challenges there to acquire data and information, so that we connect them with them, and so we can capture entire journey in the EU taxonomy in one spot.
My name is Christoph Jäger. I'm representing MSCI Real Estate for the Germany, Austria and Switzerland region, and let's say any connected analytics and ESG related topics for institutional investors, or let's say any kind of financial topics that are connected with that.
Okay, so I'd like to start with the EU taxonomy. Okay, in 60 seconds or less, what is it? Who has to follow it, and when does it start?
Those are good questions. Like, when does it start?
I can give you some bad questions too, but we'll start with the good ones.
Okay, let's start at the beginning. So the EU taxonomy is a tool to have more standardization within the financial industry and to get a common understanding of which activities in the whole economic field can be classified as sustainable or not. And it is based on an industry classification. And we at Climate Partner, we welcome this development towards standardization, but like in the details, it is still debatable. So if, for example, nuclear is a transitional energy source or not, yeah. So like that's for the beginning.
Okay, and so you're the real expert. I was just testing her. So you can go to round 2 for the washing machine. So this comes into effect, or it came into effect already. Everyone who sells investment products have to,
Yeah.
What if they're selling products that have nothing to do with sustainability?
Well, it is in force from this year onwards. It's not only sustainable investment product, but also like large listed companies, more than 500 employees, they do have to report.
What do they have to report?
In the EU taxonomy, they report on if they follow business undertakings or activities which could be classified as sustainable, meaning there is a list of economic activities in the EU taxonomy which they call sustainable activities, which in theory could be sustainable, then the second level is to go into the detailed assessment, looking if the requirements that has been set out in the taxonomy are met, and then they can claim themselves that this activity is sustainable. This could be even, for example, if you look at the environmental objective in climate change mitigation, it's very much focused on greenhouse gas emissions, for example, CO2s. Emissions equivalents, that if you stay below a certain threshold, then you could tell the public, investors, and lenders that you are sustainable in that sense.
What definition do they use for sustainability? What is the definition in the taxonomy?
The EU taxonomy approaches sustainability in two levels. One thing is they have set out 6 environmental objectives, ranging from mitigation, adaptation, transition towards circular economy, avoiding pollutions, saving the environment in terms of water and biodiversity. And you have it is approached like that. You say that you have to fulfill a minimum level there, meaning that they call it do not significant harm level, and you must contribute at least to the minimum level. Meaning it could be technical requirements, could be more verbal requirements, but you have to support at least one of these environmental objectives substantially, it's a substantial contribution. But above of that, these environmental objectives, you must also comply to a minimum social safeguards, meaning that you should protect your workforce and so on and so forth. So it has all the requirements, meaning in the environmental objectives, but also on the social side, at least to set certain minimum requirements.
And what happens if they don't?
If they don't, they are not compliant with the EU taxonomy, meaning that they cannot publish that they are sustainable in that activity. Oh, okay. And this will be shown in the CapEx, OpEx, and turnover, very much depending on what type of company you are. For example, non-financials, they do have to provide these 3 data. For credit institution, they will not provide anything about OpEx, because it doesn't make too much sense. But that's what you actually then provide to the public.
Okay, so how is this going to impact you? Because you're looking at all of the companies listed, except people forget most of the world is not on the stock market. Right. Only a very small number of companies are on the stock market, and the value of the primary market is very small. Right. Secondary market is very big. People forget that. They think every company in the world is on the stock market.
Right, exactly. Well, I think the way that we're approaching it is really on the basis of a couple of different assumptions. I think the first key assumption is that for our clients, and it's probably true of many, many users across different domains, there's going to be more than one data source that's going to be useful. So the most important thing for us is to be the best version of our data source that we can be. And then there are others, including some of my colleagues here at this panel, who will provide data that is also useful alongside the data that we provide. So that's the sort of first level. What we do at UTIL actually is quite different from what the sort of traditional ESG metrics tend to measure. So we look at the company's products and then we examine the impact of those products on the world. So that is very similar to the turnover requirement for the EU taxonomy. So we're sort of trending in the same direction. But I think the key thing is really to make sure that there is a combination of different factors that all of the different stakeholders can take advantage of. Some of it will be regulatory. Some of it will be companies like Clemens' that actually help sort of facilitate and make these processes more efficient. Some of it will be large data providers like MSCI and others, making sure that that investors and others have the information at their disposal that they really need. And then I think, some of it is making sure that we have something that we can deploy consistently across these different markets. So as you point out, the stock market is not, there's 45,000 publicly listed companies. There's probably 3 million businesses in the world that would count as sort of investable. So that's a really, really big number. And obviously, when you think about supply chains and all of these different things, there's massive amounts of impact. So I think once you look at the whole picture, to your point, Robert, it's going to take a very concerted effort across a lot of different stakeholders to get where we need to go, which is precisely, I think, the rationale behind an event like this.
So before I go to Crystal, just one quick. So if you have 500 employees, you're not listed on the stock market in your EU, and you're in the EU, you must report according to the EU taxonomy?
If you have more than 500 employees,
Okay.
yes.
What,
but
listed or not?
No, if you must be listed for now, but later on the EU
okay.
taxonomy will
So the 3
extend the
million
scope.
companies are excluded.
Now, at the moment, it's approximately 11,000 companies in the European Union. With the implementation of the CSRD, the Corporate Sustainability Reporting Directive, it will be about 50,000 in the European Union. But, however, also the smaller ones, they will be indirectly be required to report in terms of the EU taxonomy because, for example, credit institution will ask their sustainability scoring in terms of the EU taxonomy. So we think that the entire economy will be captured somehow by the EU taxonomy sooner or later. Okay. Not now, but in the upcoming years.
So Christopher, you're in one of the 2 sectors that I like the most, buildings and public transport infrastructure, because it's easy to see the difference between a building that's built with high environmental standards and a building that is not built that way. You see immediately the results. What model are you using to report to your investors who are looking to analyze their buildings according to sustainability?
So generally, as you probably know, MSCI is and was always focused on, let's say, total return, income return, so really performance figures on buildings. So at the end, we are considering ESG as one impact, obviously a substantial impact, on the quality, on the impact of the portfolio, obviously on the allocation of a portfolio, and the possible outcome. So if we have a look at ESG, we consider ESG and even climate risks as contributor or risk, vice versa, to fulfill your targeted income return, to fulfill your targeted performance. And at the end, we consider as well physical risks and transition risks, both at the same time, as so-called climate value at risks, knowing that value at risk is not the same as it would be on the liquid side, but we would consider every risk on its own. We measure every risk on its own with the comparable risk methodology based on the Potsdam Institute, Carbon Delta, we've acquired, by the way, things like that. And we would measure at the end every reasonable possible physical risk on its own and then aggregate that together to get a reasonable figure that is, let's say, at the end showing a possible, let's say, damage in the future discounted to the current capital value of a building.
Very boring. So you're focused more on risk than outcome.
We focus more on, both, I would say, because what we do
ESG is more about risk analysis and impact is more about outcome. Is anyone saying to you, hey, I want to decarbonize my portfolio, how can I do that in infrastructure or buildings?
Let's focus on buildings first. We would measure the energy consumptions of the building, the asset type, the location, the precise location, obviously. We would measure the CO2 emissions, the greenhouse gas emissions, the scope 1, 2, and 3 emissions. We would measure that.
Does everyone know what scope 1, 2, and 3 is? You all do? Okay, stand up and tell everybody. Yeah.
So my understanding is that scope 1 and 2 is like regarding to the company itself, operations and what it needs. And scope 3 would be more or less upstream supply chains.
Okay, you can go for the washing machine too.
So, yeah, next step would be to measure at the end what I said, the physical risks and the transition risks at the same time. It's both weighted with 50% because both it's relevant at the same time, knowing that we have regions within, let's say, Europe, for example, that where transition risks are more accountable than physical risks because the impact of the warming, the global warming in different regions are not so relevant on the physical risk side because simply you have not so many impacts there, but on the transition risks side, obviously you do have substantial risks. Depending on the government definitions and the government, let's say, at the end, regulations, they want to sue you if you're at the end not fulfilling the reduction requirements you should reduce.
Okay. And in your case, you're looking very much at the carbon intensity of the companies. Who's hiring you? Is it the company or is it the investor?
It's actually both. Like we have both sides. When we look at portfolios themselves, we usually get approached by the investor who wants to have a glimpse of the financed emissions of their portfolio, and then we like trickle down to the companies, work with the individual companies, so we can have a footprint of them as well, given that they are not listed and that the CO2 data is not available yet. So if they are an SME, for example, and they do not have any CO2 data yet, we work with them individually, but also with the investor itself.
So you give them a dashboard, you're doing a really shitty job. And do you help them do a better job, or you just tell them you're doing a shitty job?
We are doing the job that he can't actually do because he doesn't have the emission factors behind that. So we help the investor do a job that he is unable to do yet because he just has no tools to measure the financed emissions of their portfolio. Otherwise, they wouldn't hire us, right?
Okay. But all of you are focused on the risk. Neither of you seem to be focused on the impact. Correct me if I'm wrong. Did I miss something?
I am going to correct you. So that's one of the reasons, and it's actually one of the things that differentiates our approach, is that we are, and I think I'm trying to find the best way to describe it. It is the closest thing that we can measure in terms of outcomes, but I'm very cautious about saying that because in the world of, let's say, kind of very committed impact investing, that's much more about very concrete sort of project-based outcomes where there is funding for a given project, that project fulfills its particular obligations, and then there are concrete outcomes at the end of that. What we tried to do is try to find a way to do that where you wouldn't end up with conflicting measurements across projects. So if you take that model and you say, I'm going to fund vaccine distribution, and I'm also going to fund decarbonization, that means you're comparing CO2 to the number of doses delivered, and you can't really do that across a portfolio. So what we tried to do was find a way to rationalize that and do it at scale. So what we came up with is this idea of looking at the products that companies sell and then measure the impact in multiple dimensions on the UN Sustainable Development Goals. So for instance, you might find that there are things that are very good for creating economic growth, but are not great for the environment. That's been true for thousands of years. But you might find that there are things that are medically very positive, but they have negative environmental impacts. There might be things that are medically great in one dimension and medically not great in another dimension. So there are drugs with particular side effects. So we can start to measure all of these different impacts with a lowercase I all at the same time. The benefit is that we are looking at the effect of those products on the world, which is the opposite direction from the risk of those kind of environmental factors on the companies.
I agree. If it's true what you're saying, then yes, it's much better, because if you look, I was speaking to a family office in Singapore. I said, Robert, you can come by. And I said, okay. So I opened the door and have nearly a heart attack because there's a big sign, coal trading, oil trading, and gas trading. But that's where this family office made all their money. They want to get away from that. And they said, Robert, we've been studying this ESG stuff. We don't get it, that the most toxic companies score so well on the Dow Jones Sustainability. PepsiCo, diabetes, Unilever, processed food and semi-toxic cosmetics, Shell and BP, CO2 factories. But they score really well because the analysis is about not what they do, it's how they report.
Absolutely.
So you're analyzing what they do.
We analyze what they produce. And so we do end up with, and that's...
Again, if true. I mean, you're here, the CEO, so obviously you're not going to tell me you
I
don't
have
do
to
this.
I will fully admit that I am biased because I love what we do and I like the way that we do it because obviously I have some influence in how that gets done. So I will disclose fully that I am biased towards my company. But having said that, we are trying to do something qualitatively different in terms of how we look at these things.
Fantastic.
But it does mean that what we're trying to do is also hold companies to a different standard so that you can put our data alongside risk data, for instance.
And this is open source data?
Well,
or is this a checkbox list?
It's not a
the
checkbox
O.J.
list.
Simpson method. If I don't actually have a video of you murdering your wife, you're innocent.
No, not at all. So what we do is we take the filed revenues of companies. So that's from their regulatory filings. So they don't get to choose what they tell us. Okay. So that's the public component. And then actually we do use academic journals as a way of evaluating the evidence that connects a product and its set of outcomes. So we actually don't have, for instance, we don't have a person who decides is this a good or bad product? What we have is an aggregation of millions and millions of academic articles where we'll find thousands of academics in peer-reviewed journals who will say this product has these effects on the world.
And you're using AI.
And we're using AI for that piece of it. And what it means is that, for instance, if you take a company like Chevron or Exxon, it will have abysmal alignment on climate issues, on life underwater, life on land, all of those things. But it will have positives for industry and infrastructure. It will have positives for economic growth. And I think one of the things that I keep seeing as I look at our data is a kind of range of trade-offs that are remarkably consistent over lots and lots of different companies. And that's one of the things that I think is also part of trying to do this right, is not pretending, for instance, that if an oil company discloses that it is terrible, it should get points and it's better than the next oil company that doesn't tell everyone that they're terrible. It doesn't really work as a way of kind of evaluating those companies. And it also doesn't work to evaluate them only against other companies of the same type, because then you sort of get stuck between, you're doing great for an oil company, so you get an A. Whereas if you start comparing, again, across industries or geographies, you get something inconsistent. So it's very, very difficult to do unless you have something that you can do across all companies. But that's where I think the direction of travel really should be, is to figure out how to understand trade-offs. And the EU taxonomy is a really good example of that, of not having adverse impacts at the same time. So I think the trade-offs are really key to understand.
Does the people who worked on the EU taxonomy realize that a lot of Asia is just not going to go through that whole process, and they're just going to look at what works for them and adapt it? So it'll be quite influential, if everyone, what they're saying is true.
Well, I wanted to add to that. It's just the EU taxonomy is a paradigm change in terms of that is a paradigm change. It's greenwashing is basically over because it's really tough requirements.
It's not over. What are you talking about? The German government just raided DWS for greenwashing. What are you talking about?
With the EU taxonomy, the implementation of it, it's very clear and transparent what could be considered as sustainable and what not. It's not. There's less interpretation freedom there. So this greenwashing will fade away in the future, I believe. And you have this comparability, and then you will not see anymore these dirty businesses, let's put it like that they can claim themselves.
I'm not that convinced. They're one of the biggest private equity funds in Europe, a Nordic one with 3 letters, published on their list the portfolio of all of their investment, and they put the SDG next to the company that they invested in. Wow, that's really cool. Until I looked at the company that they invested, Zero Hunger food coloring, or we're going to eliminate poverty by giving mortgages to middle-class families in Sweden. After I made a complaint, they took it down, so you can't really check it anymore. But that was up there, so I don't agree with you. The greenwash, the American financial sector is still one of the largest investors. At the same time, pumping out press releases of how great we are, and people believe that. People believe these stupid press releases. So I don't agree about the greenwashing, except that most of the consumers don't vote with their pocketbook as much as they say, and many of them don't invest, according to their values. And the worst part is, I used to teach MBA students. I said, you want to change businesses? When the recruiter comes along, interview the recruiter. Find out, are those values yours? And if they're not, refuse to work for them. Nearly none of the students I had ever did that. They were all afraid of their student loans. I would hope that's your real lever. When a company wants to get you, and most of them, you see this concentration of theft of top staff in the financial sector because they can't find people. Refuse to work for them. That's the way you change company. You're not going to change it from inside. It's like scratching with a plastic spoon against a safe. So I'm much more skeptical because I've been doing this 25 years. I've heard the same crap 25 years ago as now. It's just better packaged.
Yep, but in the taxonomy you cannot tell them that you're sustainable anymore. That's easily to be done with other frameworks, yes, but with the taxonomy it's rather clear. You cannot tell that you're sustainable if you operate coal-fired power plants.
No,
that's it.
If in theory, great, and I hope that there's actually a team that actually checking that, because people forget how small the EU is. I mean, Brexit kept pushing, it's this massive bureaucracy in Brussels. So I asked him, okay, how many people you think work at the whole EU Commission? How many? And they're off by like a factor of 10, 35,000. There are more people that work at the Ministry of Finance in Belgium than for the whole EU Commission. So if you think that they're going to have all of these guys checking on EU taxonomy of following rules and enforcing them, I'm very, very doubtful about that. You can put out the rules, but who's going to, are people going to follow that? Christopher, our nerd on the panel over here, our real estate nerd. What do you think of the WELL model for measurement of buildings? The health and safety of the building is the sick building syndromes. Do you use it at all?
No.
Okay. That's okay. Very short answer. You're basically providing risk analysis for buildings, but do you also look at infrastructure, like public transport infrastructure?
We're on it, but the problem with infrastructure as it is that at the end you need to, or you would need to evaluate a physical risk, a total physical risk for example, an energy network. Mm-hmm. And that's quite a challenge, because if you're talking about 300, 400, 600 kilometers of energy networks, then at the end, obviously a physical risk would probably change. And therefore it's currently a bit, and bit is a very small word for that, hard to calculate a total figure. So at the end, the answer is yes, we are working on that, and we are working on that consistently, let's say, in line with what we do in the other asset classes, but we are not on it. So currently it's under development, but we have not a final model for infrastructure at the moment.
Most of your clients are institutional investors, pension funds, insurance company. Do you get many family offices also looking at this?
The answer is no.
No?
No. We're servicing normally nearly everyone. So construction companies, developers, lawyers, valuers, insurances, asset owners, everyone that is connected to real estate on the market. Everyone.
Okay. As I was saying before, that the ESG organizations that have members, they keep pushing this stupid figure of $40 trillion going into ESG. If there was $40 trillion going to ESG, we certainly wouldn't have a big problem with climate. So it's become very much like a membership card to a fitness club, telling everybody you have it but never going. And
me too, by the way.
Can we create a system that's reasonably idiot-proof for the average person to understand? Because people just want, give me the best 10, and it doesn't always work that way. Can we actually come up with a simple measurement system? Is the EU taxonomy going to fix everything? Or do we have to kind of go back to the drawing board?
Short answer is this is what MSCI is trying to do. Obviously, what else? What we do is we are transforming very complex figures, so CO2 per square meter per year, depending on the asset type and the location and whatever of a building, into something that makes sense to everyone. So at the end, for example, what is a comparable to that, and let's say can be explained easily, which is normally something that understands everyone, the warming potential. So if you see, okay, if everyone at the market would behave or would be treated like this asset, and the asset would consume exactly would be treated the same way, then the warming potential impact on the globally, depending on the model you're using, is, for example, 3.5 degrees. Mm-hmm. So that's something everyone would understand because they probably heard that for other reasons at the market anyway. And this is what we produce for assets and total portfolios.
And do you sell data to him?
The other way around.
He sells data to you.
Oh, sorry. Not that I know of.
No. So you're doing your own research and
yes.
providing that to them.
Yes, we are doing our own research.
Are you happy with the present model?
But can you repeat, like, which?
Are you because the claims of 40 trillion going into ESG is just ridiculous. So he's trying to do a better mousetrap. So
yeah.
he says, I'll keep an open mind about that. I want to see if it actually does it. Are you happy with the way that you are measuring climate information for your clients that they can actually execute? Because they, often, I remember when I was teaching at the MBA schools, and I brought in KPMG or PwC to talk about carbon, sustainable reporting, they always said, our clients always wanted the cheapest one. We weren't able to verify all the different locations. So are you able to verify things? Because companies have lots of different plans.
Yeah, let me come back to the $40 trillion in ESG. I feel like it's a problem of expectation management. So if you have $40 trillion in ESG, you can't expect $40 trillion to be like have the effect of impact investment when it's labeled as ESG. I think that is a main issue that we have with this statement.
But there's not 40 trillion going in. That's the whole point. It's not about expectation. There is not $40 trillion. It's going into Coke Light. It's not going into serious analysis of sustainable performance, which is what we're trying to do. How do we capture a better measurement mousetrap system in an organization that has hundreds of providers who never wanted comparability?
Yeah. Yeah, that's the issue. I feel like we need to turn more to the impact measurements like IRIS+, like those who are comparable, those that have metrics that can be mapped to the SDGs, for example. So you have one metric and you can compare it to other metrics and other like funds or something that use the same metrics.
Yeah, I just have to we have 14 minutes left. So exactly 14 minutes, even though we started late because of the streaming guys. But that's okay, they're kicking us out of here. The boss even came to the front line to make sure we end exactly at the time. So you have the new mousetrap. You're going to fix everything with your model using AI.
Yes.
So basically, these artificial intelligence is going to give you the information of which company is actually doing a wonderful job.
Yeah, well, in short, yes. And I think there's a couple of things that I would add. I think one of them is the $40 trillion. I think it is because the label of ESG is very flexibly applied. So of the funds that have been released over the past 18 months, probably half of them are actually just relabeled funds that existed before and did not carry an ESG label, and they were just, they were a blue chip US fund that just became an ESG fund because they changed the label, because they satisfied whatever criteria they put in place to call it ESG. So I think...
Or they dumped a subsidiary.
Or that's also possible. So there are ways of making that work. So I completely see your point on that. But also in terms of kind of using AI and using other comparable standards, particularly the SDGs, as a way of really sort of holding companies to a slightly higher standard. We actually did, and I say this without bias, please go read it. We did a white paper last year that compared the funds labeled as sustainable to the overall US fund universe. So there was a handful, a smaller number of companies that were truly labeled as sustainable, and there was very little difference between them. There was like a 2 percentage point difference in terms of the overall impact of those companies on the SDGs. And it meant that actually they were doing a marginally better job, but nothing meaningful, and actually, ironically, nothing meaningful on the climate-related SDGs, which is where all of the focus has been in the press. And so I think there is a case to be made for partly holding companies to a higher standard in general. Also, I think it's really important to make sure that the methodologies behind these things are always as clear as is humanly possible, because I think that's the piece where really investors would be most surprised if they looked at an ESG ETF, for instance, and they read the fine print and it says, well, we don't hold, for instance, in this ETF, there are no companies that have oil reserves, but there could be companies that burn oil, that refine oil. You know, as long as they don't have a big oil reserve, they could trade tons of oil futures. There could be all kinds of things in there that would really surprise an investor if they read the ESG label but didn't read the fine print. And so I think that's where a lot of this kind of these very big numbers for ESG come from.
And are you getting, I hope so, are you getting a lot more demand from investors for the information that you're providing?
Well, the EU taxonomy is just here, so it's just started, basically. The demand is just growing.
It's been talked about for a few years now.
Now it's in force, and now the obligation is here to report.
There's a law. I don't see a bunch of cops breaking into people's houses to see,
in the end,
not following the EU taxonomy.
Compared to the SDGs, it's a regulation. You must comply to it, and there is a regulator which then
You're not supposed to go fast on the highway either in some places.
Yeah, it's always a question. You may not report in IFRS if you wish, if you have to. Yes. Anyway, there's a regulator which will ask you to do so. So you could speed, yeah, sure, but you must comply to the IFRS as well.
For a fund, I would see that's a real problem if they have to kind of withdraw. But for a company, is there a fine?
There are no fines in the EU taxonomy itself, okay. But you must comply to the requirements of the EU taxonomy. And if you do not, basically it's the peer pressure element which there works. And yeah, there's no fine in the end in the EU taxonomy itself. But there's an indirect penalty, which is also like we anticipate that the financial market will react if you do not comply to it, meaning because there is a huge demand for sustainable investments, that's what we see. Clear, you mentioned already, maybe it's not always correctly labeled, but there is a clear trend towards sustainability. And I believe that it comes more from the financial market itself if you do not comply to the requirements and publish wrong data and information, basically.
Most of the world prefers to do business with you or the other 3 or 4 big ones rather than him, because he just started and he hasn't proved anything yet, but he will. So where are you going to be in 5 years? Are you going to be really not only the behemoth that actually provides all this information, but you're actually going to change the economic system by providing insight to what is their sustainable performance? Let's stick with infrastructure. I like infrastructure.
Yeah, me too. Let's start with real estate beside that first, because I'm coming back to infrastructure. But what we see, and that's, I think, really important for the time being, the data set and really what we collect on data is it's a really it's an exponential curve. So at the end, what we are really doing at the moment is we're punishing everyone to deliver data in different ways.
I don't know about punishing. How are you punishing?
No, we're just asking, but it sounds better.
Watch out, MSCI is coming to your house.
Yeah, we're coming for you. Exactly. No, what we really do is we are discussing this at the end, and that's really interesting with the asset managers and the investors at the same time, because, and this is a good point. Do we see a difference? And that is definitely a difference, because now investors are asking us before the asset managers. So simply due to ISO 50001 or even internal processes on their side, or even regulation on the due to the balance and communication topics, if they're listed or not, it doesn't really matter. Internally, they are already thinking about it, and they are some of them are much further than the asset managers on their own. And this is the difference. So at the end, in the past, it was okay to deliver something, and it was okay to even write something in a prospect or whatever. Now the clients are asking, okay, then please provide me with the greenhouse gas emissions for the total portfolio based on a remind 1.5 degree SSP2 disorderly, let's say, pathway, and they're really focusing on that. So if you're not able to deliver, you're simply not doing business with them. And that's the difference to the past, that at the end they are really doing that, and they are really measuring and comparing it.
Have you ever heard of UITP?
Sorry?
UITP?
No.
Okay, so the Union Internationale Transport Public.
So
they represent all 1,400 public transport systems, and they have to raise $2,300 billion a year, every year. And they asked us, we're looking for a different way of funding because it's very local. You know, Hanover needs 500 million for electric buses. They go to Commerzbank. Commerzbank cuts and pastes the bond of the last time, goes back to the same investors and charges several $1 million. So I said to them as a joke, when you borrow the money, you pay it back? Yeah, we're AA rated. We're, public-private partnership. So I said, why don't you just go to asset owner? You have the cheapest, easiest, lowest risk way of decarbonizing portfolio, but nobody ever approaches the public transport system. Why is that?
It's a simple matter of knowledge at the moment, I would say.
Okay, you have the knowledge now. Do something with it.
I do, obviously, right after the meeting. But no, the point is what we really see at the moment, and you asked us where we are, where we would be in 5 years. Yeah. What we see already, it will be all depending on data. Everything it will be depend on data. So independent, if I know you're saying, yeah, we are probably not good enough. We are probably not where we should be.
I didn't say that. You said it.
He
said himself, MSCI is not good enough. Okay. I hope it's being streamed to the universe.
All good.
I think what happened to HSBC guy is not going to happen to you.
What we want to say is, depending on, at the end, the increasing knowledge, depending on increasing data, let's say the number on let's say simple better decisions will increase. That's simply what we already can see, and what, if you ask us where we will be in 5 years, then it's simply a clear combination of, and this is simply working better, has nothing to do with ESG, measuring performance, investment strategy decisions with ESG. And it's a clear, substantial part of the decision package, and not just, yeah, but we have to do ESG, yeah, no one cares about it.
Where are you going to be in 5 years?
We're very happy about the CSRD because right now 11,000 companies have to report according to the CSRD, and it's going to be 50,000, and all of them are also going to have to measure their carbon footprint. And with that, we're going to have a real world impact, because once companies start to measure their own carbon footprint, they can't avoid having a look at it and thinking about how we can reduce it. So with that movement within the CSRD, we're going to have the real world impact, and we're happy to support on that way.
And your AI business will be sold to MSCI in 5 years.
Why does everybody keep saying that?
Just give me a card.
That's the model.
They're
hoovering up all of the independent research providers. There's nearly hardly any left. Not only MSCI, Morningstar, Sustain. It's going to be just a commodity.
Well, and I think that is true in the data sense. Like data is like it is increasingly becoming commoditized. It used to be the case that if you had information that someone else didn't have, you had an advantage, and then everybody had the same information. And now we're getting to the point where everybody has too much information, and sifting through that information and finding what's important is the key challenge. And now we have so much information that we need machines to help us understand it. So we're sort of reaching a different moment where I hope we'll be in 5 years' time, not, with no offense to MSCI at all, is not acquired by MSCI, but rather essentially helping anybody making a financial transaction make that transaction more sustainably, wherever that is. I think that's ultimately what a lot of us are trying to do in various different ways, but ultimately that's where I want us to go.
And you?
I just can follow on that the CSRD will be implemented, basically capturing mainly more or less the entire European market, clear, but there are trends in America as well going the same direction. And that the EU taxonomy is established as the decision-making tool for investments in any sense, meaning like that investors can decide on have really a comparable basis, and that's where I'm aspiring to be in 5 years.
Okay. One important statistic to remember, according to Credit Suisse, if it's accurate, there's 4.5 times more wealth than there is GDP. 450% more wealth, a lot in real estate and infrastructure, than there is business. Remember that figure when you start wondering, why is this market going like this? There's too much money chasing really shitty projects that will do nothing to address climate. We're not going to suck out CO2 out of the air by a stupid machine in Zurich or one in Iceland. This is beyond stupidity. This is beyond, but all of this money is pushing the unicorn hunters. And I would prefer that they wore a MAGA hat and say, I'm a unicorn hunter. I don't care about impact. I want 10x. Just do that, and it's okay. I don't care if you want to die rich as quickly as possible. And another thing to remember, I once met the head of Goldman Sachs in the Netherlands, and he said to me, I said to him, I can't prove, but I have a feeling the investment manager is wrong half the time. He said, no, 3/4. So I think, wow, would I go to a doctor, dentist, car mechanic, plumber, painter if 75% of the decisions were wrong? But it's okay for the investment manager to be overpaid by a factor of 4 and underperform by a factor of 4. Enjoy your day. A TB MMA cage fight for all of the ESG measurement and frameworks. Go to our website, tblibwp.org, and it'll be a library of every single measurement system that will perform, will able to capture, and you will be able to vote. It'll be the wisdom of the crowd. tblibwp.org. Thank you.